Hi everyone, welcome to this video where we are going to calculate material variances. There are three variances that we are going to look over here, that is material price variance, usage variance and total variance. Material variances are basically concerned with two things, that is the price or the cost of materials that you pay to purchase the raw materials and the quantity of these raw materials that you use for your production. So we look at the three variances, and after that we'll consider an example, a question where we'll calculate all the three variances properly. So the first variance, that is your material price variance, as the name suggests, it talks about the variance in the price, that is what the price should have been or the cost compared to what it actually was. And then we quantify that for the total quantity of your material that you purchased and used. So if we were to write it as a formula, we can simply say it is your standard price minus your actual price into actual quantity. For example, let's say you should your standard price of raw materials per kg should have been $10, whereas in reality when you purchased it, it was $12. That means you have paid $2 more per kg of the raw material. So that is $2 adverse. And let's say in reality you had purchased 100 kgs. So your material price variance in this case would be $2 adverse into 100 kgs, that is $200 adverse. The next variance is your material usage variance. This variance talks about the difference between how much materials you should have used for your actual production compared to how much you actually used. And then we quantify that in terms of in monetary terms by multiplying it by the standard price. So in terms of formula, it could look something like this. We can say standard quantity for actual production minus actual quantity purchased and used into standard price. So say for example, you produced 15 units and each unit should require 10 kgs of raw materials. So you should have used 150 kgs. But let's say you actually used 200 kgs. That means you have used 50 kgs more than what you were supposed to. And hence in terms of kgs, that is 50 kgs adverse. Then we convert it into monetary value by multiplying it by the standard price. Let's say the standard price is $10. So 50 kgs into $10, your material usage variance would be $500 adverse. And lastly, your material total variance. This is simply the difference between what should have been your cost for the actual production compared to what really was your cost for your actual production. So in terms of formula, we can simply say it is your actual production or number of units into standard quantity per unit into your standard price, this, and the difference between whatever was your actual cost of raw materials purchased and used. Another way you can do is where we say your material total variance is nothing but the sum of your material price variance and material usage variance. For example, if your material price variance was $50 adverse and your material usage variance was $200 adverse, your material total variance has to be $250 adverse. When you're adding up two variances, treat adverse numbers as negative numbers and treat favorable variances as positive numbers. And remember, variances always have to be either favorable or adverse. So now that we have seen had a look at the three variances and what they mean, let's have a look at an example and calculate all three. So here is an example where you have your standard information given to you. That is, the number of units to be produced is 10 units. The material that would be required for each unit is 10 kgs, and hence for 10 units you should require 100 kgs. The cost per kg of your raw material is $12, and hence for 100 kgs your total cost should be $1,200. After production, in reality we produced 11 units and we used and purchased 120 kgs. The cost per kg in reality was 12.5, and hence the total cost of our materials was $1,500. So in this case, as we can see, a standard or the budget is quite different from actual. We'll calculate the three variances over here. So coming to the first variance, which talks about your material price variance, and the formula was standard price minus actual price into actual quantity. In this case, our standard price should have been $12, but in reality we paid $12.5. That means we have paid $0.5 more per kg purchased. So how many kgs did we actually purchase and use? 120. So this means your material price variance is $0.5 into 120, that is $60 adverse. And you can see the calculation is as simple as that. Moving on to the next one, that is material usage variance. It says the standard quantity for actual production minus your actual quantity that was purchased and used into standard price. So in this case, the standard quantity that should have been used was 10 kgs and actual production was 11 units. So we should have used 110 kgs of raw materials, but in reality, we used 120 kgs. So in terms of kgs, that is 10 kgs adverse into your standard price, which is $12. And hence your material usage variance is $120 adverse. And coming to the last variance, that is your material total variance. Material total variance is your material price variance plus usage variance. So in this case, we had $60 adverse and $120 adverse. So our material total variance should be $180 adverse. We can verify this by actually calculating the variance as to what our expenses should have been for producing 11 units as per the standard and what the cost actually was. So for 11 units, you should have used 10 kgs, which should have costed you $12. That means our total cost should have been $1,320. But, okay, let's just say this is your expected cost for actual production. But our actual cost was how much? $1,500, which means we have spent $180 more than what we were supposed to, and hence it is $180 adverse. So this is how you can verify your material total variance. So a quick recap, your material total variance will be the sum of your material price variance and usage variance. Likewise, your material total variance minus price variance would be your usage variance, or your material total variance minus usage variance will be your price variance. It can get a bit confusing at times, but as long as you understand the logic that as long as your cost or the quantity of material used is more than what it should have been, is going to be an adverse variance, else is going to be a favorable variance. Remember some of the terms: what is the standard price, what is the actual price, what is the actual quantity, and what is the actual total cost compared to what is your expected cost for actual productions. Once you get familiarized with these terms, it will become easier to calculate these variances. So hope this example was useful to understand all the three variances in detail. We'll consider the labor variances in the next video. If you have any questions or queries, please leave them in the comments, or you can email me. My email address is at the top. And if you find these videos useful, please subscribe to my channel and share these videos and links with whoever you feel can benefit from them. Thank you.